I think what people need to understand is, first of all, the CME Group raised margins to all-time highs. Raising margins is, first of all, people think it's very bearish. In my mind, it's not bearish. It's the exchange telling you that this move is real and it's getting violent. It's bearish at first because the amount of money needed to hedge positions increases exponentially.
What's going on, precious metals community? Andy Schectman from Miles Franklin just dropped some explosive insights about what really happened during that brutal silver crash we all witnessed. He's calling out the margin hike manipulation, revealing how institutional players scooped up 33 million ounces at discount prices while retail investors panicked. And he's making a bold prediction that silver could hit all-time highs by March. This is the kind of insider perspective that connects all the dots between COMEX inventory squeezes, the new Project Vault strategic reserve, and why governments are suddenly treating silver like a national security asset. You're going to want to stick around for this entire breakdown because Andy reveals exactly who bought at the bottom and why this shakeout might actually be the setup for the next massive leg up. Drop a comment below and let me know where you're watching from. I love seeing this community grow from all corners of the world. All right, let's dive straight into what Andy had to say.
Since we've had this guest, Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us nominally every week for a weekly market update, but it's been 3 weeks. He's back here again. Andy, thanks for joining us again on Liberty Finance. Today is Monday, February 9th, 2026. Thanks for coming back on for this weekly market update.
It's great to be back, Dunnigan. I had some travel, both for work, for fun, and I appreciate you bearing with me. But of course, while I'm gone and trying to relax, the world seems to fall apart from underneath. And but don't worry, it all is okay, I assure you. And but we'll talk about it. It's good to be back, my man. Good to see you.
Glad to have you back, and we definitely are going to hit that as our main line topic tonight. Is what in the world happened to the metals markets over the past 9 days? We're going to get into that. First, we wanted to recap quickly a cover back to a topic that we brought up briefly in passing about. It was actually raised by a client when there was this huge run up in silver prices over $100, and the U.S. Mint suddenly shut down and said, okay, we're not going to sell stuff until further notice. And they fixed their prices and jacked up the prices again from their uncirculated silver eagles and their proof silver eagles by a lot that they hadn't adjusted in a long time. And we had some concern about what's the difference between a BU, or brilliant uncirculated silver eagle, purchased through Miles Franklin or other dealers versus the uncirculated silver eagles that are sold by the U.S. Mint. And if you can enlighten us on what the difference turns out to be.
Yeah, I guess it's just a frosting on top of the BU, or the uncirculated, the BU coins that we sell. The commercial strike, I guess, just don't have this frosting, which is nearly impossible to discern between the two. In essence, it's lipstick on a pig, and there's no reason to buy the uncirculated coin from the U.S. Mint, because the brilliant uncirculated coins, uncirculated being the U in BU, that you're getting from any dealer like myself, is just a better value. I guess if you're collecting it as part of a set, where you're collecting the proof and the uncirculated coin as issued by the Mint, one set or whatever each year, fine. But again, anything that you're buying from the Mint is not really economical from the standpoint of building your core position. It's more along the lines of things that you want to collect. And most of those things won't return their value. Some of them will, I guess. Some of them are made in very small quantities, and maybe they will. But certainly that's kind of the sprinkles and the hot fudge on top of the vanilla ice cream, which would be just the normal commercial strike, where you're getting more content rather than frosting, so to speak.
Yeah, that finish, ironically, many people who see and hold and touch for the first time one of the BU American Silver Eagles or other government minted BU coins that we sell are just blown away by the beauty of the engraving. The mirror-like finish is one of the things that attracts them. So you could get a frosted finish if you don't want the mirror-like finish. But as you point out, you're going to be paying a huge markup to get that from the U.S. Mint, and it doesn't always pay off in terms of investment value. So for your core position as an asset, the BU, brilliant uncirculated with the mirror-like finish that you can get from Miles Franklin and other reputable dealers, is the way to go for the bulk of your holdings. We also had a question for you that's been submitted by a number of different customers in the past.
This is exactly what institutional players don't want retail investors to understand. When Andy Schectman said margin hikes mark the point where the next leg higher becomes inevitable, he just revealed the playbook smart money has used for decades. During these violent shakeouts, weak hands get flushed out while institutions back up the truck at discounted prices. The evidence is right there. When silver had its biggest one-day drop, SLV absorbed the largest one-day metal inflow in years the very next day. We're talking 33 million ounces flooding into the ETF while retail panicked. That's not fear. That's strategic accumulation by players with massive balance sheets. Here's what most people miss. Margin hikes don't stop physical demand. They stop paper leverage. The CME tripled margin requirements from $18,000 to over $53,000 per contract. This destroys leverage traders. But for 15 straight months, we've seen relentless delivery demands on COMEX. These players are paying cash for physical metal. And look at Project Vault, the government's new critical mineral reserve. 6 consecutive years of supply deficits. They're treating silver like a strategic asset now. When governments start stockpiling, that's your signal the scramble for physical has begun at the highest levels.
Week, they're running around. We had 3 very concerned clients reach out last week and another one today saying, I've got to get this done quickly because there's going to be this new federal government reporting requirement that's going into place on February 14th, and we got to get this done right now, but I have to make sure that I don't go over the limit because the new reporting limits and everything's going to be reported to the government by every dealer after February 14th. Can you tell us the truth about what's really going on? Any change to reporting?
Yeah, I mean, I don't see that anywhere. I haven't heard about that. And look, one of the reasons we left our company in Minnesota, our corporate office, is, even though I'm in Florida where we've had this satellite office for 15 years, I could have moved it out of Minnesota, out of the craziness there, and saved money. But I left it there because we're held to a higher standard through licensing, bonding, continuing education, compliance, and this has not been brought to my attention anywhere. And I've looked for it and can't find it. Now, there are several of these Asian guy channels. The one that I follow that I think has the best information, at least so far. Again, I haven't followed all of them, but the OG John Agee, the original John Agee, he's one I follow. He didn't say this. It was someone else. I don't know. I can't see it anywhere. It's created nothing but anxiety, and I can't even figure out why they would have said it, other than maybe try to get people to sell before, before this mandatory reporting comes in. But to my understanding, to my own research, to everything my compliance department has told me, there is no such law that has been placed, and it's, for whatever reason, misinformation as far as I can tell.
Now, there has been a change. July 1st of 2025, there was a relaxing of mandated dealer reporting for 1099B capital gains, so that a lot of people's, if they have a personal financial advisor or a tax advisor who isn't up to date, they may still be going off of what had persisted for years and years and years. There were about 6 or 8 different categories that would trigger reporting limits in the past. Now it's just down basically to 1 limit for silver, 1 limit for gold, 1 limit for platinum, palladium. Basically, it's a certain number of bars in aggregate.
That a certain number of bars in aggregate in one transaction that would satisfy a COMEX contract. 5 1,000-ounce silver bars, 3 gold kilos, or 1 100-ounce gold bar in one transaction, which is the definition in both cases of a COMEX deliverable contract. So anything other than that, no reporting.
So that's actually less reporting than there ever was in the past, because it used to be there was 25 gold Canadian maple leafs or 25 gold Krugerrands or $1,000 worth of face value of junk silver. So if people want to get the new reduced reporting requirements for 1099B, which dealers are still mandated to follow if individual transactions go beyond those for those very few examples, just email us at libertyandfinance, all spelled out, all one word, libertyandfinance at protonmail.com. Just put 1099 in the subject of your email. Please put your name in the email so we know who we're responding to, and we'll be happy to get back with you and send you that reduced list, a very short list of mandated dealer reporting, which only applies to COMEX contract size amounts of bars in either gold, silver, platinum, palladium. Does not apply to any coins at this point, so, or rounds. So very interesting. Actually less reporting and yet more noise being made about it all over the place. Okay, so let's get back to the main headline topic of the day, and that is what in the heck happened over the past week and a half.
The March contract situation is absolutely critical right now. We've got over 400 million ounces of paper silver tied to the March contract, but only 103.5 million ounces in COMEX registered inventories ready for delivery. That's a 4-to-1 ratio of claims versus what's actually available. Here's Andy's razor-sharp point. If even 10% of that open interest stands for delivery, you're talking 40 million ounces. If 20% stands, that's 80 million ounces, consuming a massive chunk of registered inventory. And the first notice day is February 27th, less than 3 weeks away. The pressure mechanics mirror what we saw before silver ran to $30 in 2020 to 2021, except registered inventories are much lower now. The market either pays up through backwardation or pulls from the eligible category. But that 294 million ounces in eligible, most is not for sale. And this connects to the global fracture happening right now. The arbitrage between Shanghai and Western exchanges isn't closing because China is intentionally keeping prices elevated to pull physical into their market. BRICS payment systems are facilitating trade settlement outside SWIFT. ASEAN countries with 800 million people are settling in local currencies and balancing in gold instead of treasuries. This is infrastructure for a parallel monetary system that settles in physical metal, not fiat.
We were on our way into a Cloud9 new reality of metals prices. People said new price discovery is finally going to happen. The physical markets have taken over and fundamentals are driving this. And then all of a sudden the trap door opened and the bottom fell out. Now looks like there may be some floor being found, but can you tell us what we know about what happened and what we know about where we are going at this time?
Yeah, I'm just looking to see what silver is at today. Haven't looked yet.
It was 83.5 last time I looked.
83.97 I show right now, up 571, and gold at 5,081.50, up 110 bucks. At 84 bucks, I mean, we were at 65 on Friday night. So here we are, that's over 30% right back. I think what people need to understand is, first of all, the CME Group raised margins to all-time highs. Raising margins is, first of all, people think it's very bearish. In my mind, it's not bearish. It's the exchange telling you that this move is real and it's getting violent. It's bearish at first because the amount of money needed to hedge positions increases exponentially. They've raised it twice right around Christmas, a few days before and the day after. It was like $18,000 to hedge 5,000 ounces of silver right around Christmas time. The day after, it went to 27,000 ounces, and now we're above $53,000, $54,000, $55,000 to hedge 5,000 ounces for a company like ours that would normally have 2 million ounces of silver in the warehouse becomes very expensive. You better have $50 million in your margin account, or you're not going to keep much in the way of hedged inventory of gold and silver. But this is also true of speculators. And, you know, the margins are a percentage of the contract's value. So when gold and silver go up, the contract gets bigger and the margin requirement goes up automatically. That's a new thing. It used to be a fixed rate. Now they're making it a percentage. So, you know, the math does this as the price goes higher. Okay, that's fine, but they're also adding volatility into the equation. And when the market starts getting swinging, like we're seeing up 30, down 30, they can raise the percentage that you need on margin. And that's when it really bites. And because now you're getting squeezed from both sides, higher prices and higher margin rates. But here's why it's bullish. And to me, it's bullish because margin hikes don't stop physical demand. What they stop is paper leverage. And they force the weak hands out. And they reduce the ability to run giant positions just on thin collateral, where you can control massive positions by having a small margin account. And so, yes, you will get a paper flush when this is implemented, like we saw. And futures can and did drop when the leveraged traders are forced to liquidate. But that's not the end of the bull market. That's the shakeout. And the people that have been standing for delivery, as I've been really screaming about for quite some time now, for 15 straight months, so they're not using margin. And so these are the big money, the banks. You know, could it have been a one last attempt to bail out some of these U.S. banks who still had? Now, we've been talking about the Commitment of Traders report that said the U.S. banks are net long. We've talked about the report that came out of the Economic Times that said the banks are net long. But being net long doesn't mean you're long only. That means you have more long than you do short.
The retail demand surge reveals what analysts are completely overlooking. Andy's company did $900 million in sales for all of 2024, but $300 million in January alone. That's 1/3 of their annual volume in a single month. And this is happening across the entire dealer network, with less than 1% of the public invested in precious metals. Think about that. If institutional allocations even start moving toward the 20 to 25% recommendations from Morgan Stanley and Bank of America, the supply chain bottlenecks become permanent. The physical market cannot absorb that demand without dramatic repricing. Andy predicted silver back at all-time highs by March, putting his reputation on the line. But look what happened. Silver bounced back over 30% almost immediately after the takedown. JP Morgan covered almost 700 contracts at the absolute bottom. That's 3.5 million ounces. Smart money used that engineered panic to add positions. The logistics reality is critical. Physical metal has delivery timelines, verification processes, and vault constraints that don't exist in paper markets. Dealers are weeks behind on buybacks. Some stop purchasing certain products entirely. You cannot assume infinite liquidity will be available when you need it. Position your holdings where you want them before the next volatility spike, not during it. So what do you guys think of this? Leave your thoughts down in the comments. Please like and subscribe, and I will see you in the next video.